Hello, ladies and gentlemen. This is Mark Patricia, the founder of Technically Sorted. And today in this video, I'm going to talk about a certain very important thing I've been having in the back of my mind to talk about. And that is what, a lot of people are confused about what is quantitative trading, right? What is algorithmic trading and what is technical analysis based trading. Okay. Why is trading having so many different approaches when all you have to do is buy and sell, right? And let me just clear the wheat from the chaff and make it all very clear to you. First of all, what is the form of trading execution and what is the form of trading analysis, right? Or market analysis, right? So what we're going to do is we're going to get a clarity about each and every little term which is involved and very ubiquitous in the world of trading, so that you all get an understanding of okay what this exactly is, right? So let's first come to a point that whenever we are doing any kind of market analysis, right, or we are going to do some execution of trading or automate a trading model, all of it boils down to understanding what trading strategy is, so that it helps us define the rest of the terms very easily, right? So a trading strategy is basically something which is going to give me a context of trading. It is going to give me a context of when to buy, when to sell, what to buy, what to sell, right? And it can be based on a lot of things. It can be based on uh, various different factors. That depends on how I look at the market and how I study the market, right? So let's understand this. First thing is first that the understanding of the basic sciences behind market analysis can have different approaches. Right? There are traders and investors who really, really respect technical analysis. I have seen that there are a lot of them who shun it off. Say, okay, I don't want to use it. There are a lot of traders and investors who respect fundamental analysis. And I have seen that a lot of successful traders and investors also uh, give more weightage to technical analysis, and that some of them say, oh, I'm more interested in the momentum. Okay. Now, market analysis, broadly speaking, has these two different categories of approach, right? Now, other than this, there could be some other alternative or sort of data and evidences and market information that could fit in a mix of both. That could also tell us something with regards to fundamental, at the same time, something with regards to technical analysis. So all of that can be present. I'm not getting too much into that. But broadly speaking, there is a fundamental analysis present out there and technical analysis present out there. Now, the big question is, so what is quantitative research or quantitative analysis? Okay, quantitative research. Okay. Now, when we are doing quantitative research, we in essence are doing what is we are trying to quantify everything into numbers. Okay. Now, before we get into what is quantitative research and how it is done and what are the use cases and how it can be applied, we need to first understand that what technical analysis is and what fundamental analysis is and what are the purposes. So in a quick short thing which we're going to do is we're going to understand that technical analysis has certain assumptions, right? And one of the assumptions is that history repeats or rhymes. Okay. On the other hand, technical analysis provides us with a template. What template? A template to gauge buying pressure and selling pressure of the market. And it is very useful for immediate and short term price momentum, price movement. Okay. So short term price predictions and short term predictive value is very high on technical analysis. On the other hand, fundamental analysis is often used to be able to invest for the long run. Okay. Investing principles have a lot to do with fundamental factors. Okay. It could be used for portfolio management. So instead of portfolio strategies or a lot of trading, right, you could be doing portfolio management, which is creating a diversified portfolio of stocks, right? And the principles of fundamental analysis is that we need to find value, or the basic what we need to gauge from fundamental analysis, how much value is in the stock if we connect it to the business of the company. Okay, so these are the two different market sciences. And when we are doing quantitative research, right, we're doing quantitative research, we are applying to any one of those market sciences. Now I'm coming to this. Now, other than this one of the market sciences to which we are applying quantitative research, there could, as I said earlier, be other aspects which are, broadly speaking, statistical models. Okay. So first thing first, let me define quantitative research as something which can be applied to both price analysis as well as company analysis or economic analysis. Okay. So when you're doing quantitative research, you could actually be borrowing a lot of technical analysis while you're creating, say, for example, machine learning model. You need features, right? I have seen that a lot of features are based on the templates provided by technical analysis indicators. Okay. A lot of logic on trading, otherwise also, or risk management logic could be based on technical analysis. Quantitative research can also be used for something like portfolio management, where you are, churning long-term portfolios. Basically, the perspective is to invest and not to trade, right? So quantitative research could be done for both trading and investing. And quantitative research could also be done to be not just directly taking decisions on technical analysis or fundamental analysis, but to be aiding a technical analyst or to be aiding a fundamental analyst, right? To provide insights and inputs. Now let's come to the bigger question. So then what do I define as quantitative analysis? Right. So any kind of research which is quantitative in nature, okay, any kind of research which is quantitative in nature means that we are actually quantifying something. What do I mean by quantifying? I mean to say finding a certain measure of something, right? Now, if I tell you that I'm using technical analysis to see that the support of a stock is breaking and I need to go short, and that is a very confirmed signal, say for example, there is a pattern information which is at the end of its completion. There is volumes which is supporting the movement, there is a strong bearish movement in the market, etc., etc. So I'm using all of that as a subjective visual analysis in order to trade. But I'm not exactly quantifying it in that moment, right? Now, when I'm using a set of subjective rules, okay, now speaking of trading, trading can be done as randomly as possible, as systematically as possible. So let me just give it a range. I'll call this random. Okay. A random person would be trading, a person would be trading randomly if they're doing absolutely, trading by their own motivations and gut feelings and a sort of subjective judgments. And the trading could be as systematic, okay, as systematic as you can make it rule based. Okay. So it can range from random to systematic. And I could be doing trading on the basis of a number of things. Now, since I told you we are broadly speaking about trading, not investing, so I've left the investing part aside for some time. But whatever I'm saying does apply to quantitative investing or quantitative portfolio management as well to some extent. Okay. So when I'm doing quantitative research, say for example, I'm doing quantitative research to be able to predict the price and to be able to use any of the methodology under quantitative research to help me make decisions for trading. Okay. Now we'll come into what those methodologies are. But suppose I use some simple methodologies. One of those inputs could be technical analysis. A lot of those inputs could be technical analysis indicators, and a lot of those inputs can be machine learning models. A lot of those, I would say, inputs could be machine learning models. There could be machine learning models applied, and there could be statistics applied. Okay. Now, why quantitative research? Because quantitative research includes creating trading strategies. How do I create it? Now, as I gave you the example of support breaking down, I probably can't quantify it that easily. But if I say that the price is moving with a certain statistical quality, I can quantify it. For those who are not familiar with too much statistics, just to give you a simple example, let's not take statistics, let's take a simple trend following indicator. It is easy for me to quantify that the price has just crossed the moving average and in an uptrend it has started to trade above that move. I can quantify. I can give that a decision as a yes or no, right? So whenever we have some things which can be objectively seen and inputs that can be objectively quantified, they help us in certain ways, right? They help us in which ways? They help us in being systematic. Okay. So the more systematic I want to be, the more I'm trying to make my decision making objective, the more I'm trying to make my decision making rule based. Okay, that is what systematic means. Something which is rule based. Now, while creating the rule, I am allowed to create those rules on the basis of my discretion or subjective understanding. Okay, but but when I'm creating a rules or a set of rules, obviously I want to see if those rules are valid, right? What quantitative research does is it helps us not just create the set of trading rules using technical analysis indicators and using statistics, it also helps us to validate those rules. Okay. So there are statistical models which help us to do a lot of simulating or forward testing or walk forward approaches, which help us validate our trading rules. Okay. So if we have created and being able to validate it, in between also there are some steps like optimizing, etc. that can be done. Now, in the process of quantitative research, what one is doing is they are trying to create something systematic. In the end, if they want this systematic, that can be traded manually also. So, for example, I have a statistics based scanner, which during the market hours gives me certain prompts and certain signals. Now, depending on how systematic I am with those signals, I can directly take that signal and use it to take a manual trade, right? I'm trading it, the execution is manual, but my decision making is based on the set of rules, right? Second is if I have a system in place and I have automated it, right? So when I've automated it, it comes under the umbrella of algorithmic trading. Okay, so that is where the overlap between quantitative trading or algorithmic trading happens, and that is why algorithmic trading and quantitative trading are often used interchangeably. Because whenever you're putting an algorithm, if you're smart enough to execute a trade using an algorithm, obviously you are smart enough to quantify the validity of that strategy over a period of time, right? So the important point to remember here is that I don't want to trade randomly, and it is not good to trade randomly. It's not ever profit taking. It's not a profitable thing to trade randomly, right? Now, between random and systematic, there could be a space of a lot of subjectivity, right? So there could be a lot of subjectivity in this area between random and systematic. So somebody who is completely systematic will be rule based, and somebody who still uses some subjectivity can have a market knack, and they are allowed to. Some of the very, very good traders I know don't trade completely systematically. They do believe in market knack. Okay. Now you have to find where is your sweet spot. So if you think your sweet spot is to automate everything, weed out all the emotional implications of trading by automating everything, right? Then you have got yourself a good deal because you can directly use quantitative research and apply that on trading and create algorithms that are automated, right? Now let's completely focus on what quantitative research is and what all does it help us to do, right? Quantitative, okay. Now quantitative research, as I said, it means to quantify something. So when we are trying to do trading, we try to quantify a lot of price-based analysis and also, so which happens on the open, high, low, close, and volume data. But it can also have alternative data sets, right? There could be alternative data which could help us to understand where to buy, where to sell, what to buy, what to sell. Okay. Why? Because when we're quantifying everything, we can do a lot of experimentation. A lot of it's done, or in fact, all of it is done through either earlier it used to be done through Excel, and now everything is done through computer programming languages, right? So if you can first create a strategy, do some back testing, do some optimizing, do some forward testing, do some approach with regards to paper trading, and then create an algorithm, then you are a quantitative trader who is trading algorithmically. Okay. And if you are using the same quantitative research, and your focus is not particularly using quantitative research for price analysis, but a mix of things, a mix of different factors, and not for trading but say investing, then you could also be a quantitative portfolio manager, right? Now, who are quants? Quants can refer to a number of different sort of a set of people who are involved with quantitative research, quantitative trading in the firm. And this could include quantitative development. So this means you have to developing the execution of trading strategies. Quantitative research means to create, backtest, and validate trading strategy. Quantitative development means to ultimately put them to execution. Quantitative trading could be mix of both and making the decisions, right? And there could be a lot to do with risk management. So you can have somebody who is doing quantitative risk management, right? So there could be all of these various roles, and all of them are called quants, right? So why is this so? Because obviously you can be a quantitative trader and you can call yourself a quant sitting at home and trading. And you could use quantitative analysis and automate your trades and do everything. But when there are a lot of big firms, also colloquially known as quant shops, there are hedge funds who use quantitative research. There are HFT firms who do the same, right? Use quantitative research. There are other proprietary trading firms who use quantitative research. So people working under that umbrella in any of these different capacity are known as quants. Okay. So the use cases for quantitative research can be a number of, there could be a number of use cases for quantitative research. And a few of them would be to actually creating trading strategies, optimizing the trading models which are already there, and validating those strategies. And one more use case which would be is while not just research but in live in action, that is using it for risk management. Okay. Then a lot of people believe that now it is time for us because of the power of technology, a lot of open source, libraries to be able to create stuff, and people actively gathering more and more skill set in order to migrate to algorithmic trading. So there are a lot of people who do believe that quantitative research can be applied as quantitative trading through algorithm. So there are a lot of advantages of doing this. That is the speed and accuracy, trading psychology. So the speed of accuracy is completely restored, right? Trading psychology is completely out of the picture. Trading strategies, at least they are very much proven with different approaches. They are proven that, okay, that this is something that works, right? And this something is very likely to work, right? because you see it across different market regimes, etc., how it has been performing. And also you anticipate extreme market regimes and see how they have been, they have we could perform, right? Especially when you're using derivatives and maximum value at risk, etc. And trading is highly scalable with the help of algorithmic trading. So if you use your quantitative research, and that is basically use a lot of brains and a lot of concepts to be able to trade algorithmically, then you have got it right, and you've understood how the connection between algorithmic trading and quantitative trading actually is. Right. So this was my small attempt actually to be able to clarify things between what are the different types of trading. And there are people I have heard, they say, oh, technical analysis doesn't work. Then I have people who say that I do, I completely believe in technical analysis. I don't believe in anything else. Now I believe, the message which I want to give over here is don't take sides, right? Why? Because everything has its pluses and minuses. Okay. The first people who actually started do algorithmic trading were actually technical analysts because they went deep enough into the price, given the resources and time back then, that they were able to find out that there are patterns that can be quantified, right? So under technical analysis, there are modern technical analysts and evidence-based technical analysts. And after a point, when you get into deep enough research and trading, there is all these jargons and terms in trading just make very little sense, because you have to figure out ultimately what works for you, what is suitable to your personality, your research, your knowledge, and your approach, right? I have restrained myself from speaking about machine learning. So allow me to tell you one thing, that there are a lot of machine learning models which come under the umbrella of statistics and quantitative analysis that are also used, right? So, that you have something which is a tool. Machine learning is a tool, but what you input in the machine learning can range between technical indicators and fundamental factors and economic factors and whatnot. So please keep these things in mind, that there's a lot of subjectivity around these terms and how we look at it. But specifically, who quants are, I told you. What is the overlap between algorithmic trading and quantitative trading? I told you. What is the difference between manual trading and quantitative trading? I told you. What is the difference between discretionary trading? As I said, discretionary trading and uh, non-discretionary trading. Okay, that I've told you. So overall, thank you all for watching this video. This was a small attempt to clarify these things. To be able to find more stuff on algorithmic trading and quantitative trading, have a look at the other videos in my YouTube channel. And also, I request you to go and check out technicallysorted.com, where I have a lot of free digital products only for you. Thank you so much. Have a good evening. Bye bye. Enjoy.